Today, I'm going to walk through exactly how I use a cash-secured put on NVDA to generate income and potentially acquire shares at a more attractive valuation. This is not speculation. This is structured capital deployment. When you sell a put, you enter into a contract, agreeing to buy 100 shares at a predetermined price, called the strike price, before a specific expiration date. In exchange for accepting that obligation, you receive premium immediately. That premium is yours to keep. Every options contract represents 100 shares, so if I sell one put, I am committing to potentially purchase 100 shares. A cash-secured put means the capital is already reserved. No leverage, no margin exposure. The funds are set aside in full. Let's walk through a clear example. Assume NVDA is trading at $185 per share. Instead of buying at $185, I determine that $170 represents a valuation where I am comfortable owning the company long-term. So I sell the $170 strike put, expiring in approximately 30 days. For making that commitment, I collect $300 in premium. Because one contract controls 100 shares, I reserve $17,000 in capital. From here, there are only two outcomes. If NVDA remains above 170 at expiration, the option expires worthless. I keep the $300. The capital is released. That is realized income. If NVDA trades below 170, I am assigned and purchase 100 shares at $170. However, I already collected $300. That equals $3 per share. So my effective cost basis becomes $170 minus 3, which equals $167 per share. Either I generated income or I acquired a high-quality company at a discounted effective price. Both outcomes are acceptable. Now let's discuss probability. Delta provides an approximate probability that the option will expire in the money. If the 170 strike carries a delta of 0.25, that implies roughly a 25% probability of assignment. Lower delta reduces assignment risk, but also reduces premium. Higher delta increases premium, but increases the probability of owning the shares. This is a risk-reward decision, not speculation. Now let's talk about management. I do not need to hold until expiration. If I collect $300 and the option value compresses to $150, I can buy it back and lock in $150 of profit. Many disciplined traders close positions at approximately 50% of maximum profit. This reduces exposure time and allows capital to be redeployed efficiently. Now let's address volatility. Premium is largely driven by implied volatility. When volatility expands, premiums increase. When volatility compresses, premiums shrink. Selling puts during elevated volatility can increase income collected, but it also increases downside movement risk. Strike selection and position sizing matter. Now let's address risk clearly. If NVDA declines sharply, for example to 140, I am still obligated to buy at 170. That means I may temporarily hold shares below my entry price. This strategy shifts the decision from predicting direction to defining valuation. That distinction is critical. A cash-secured put is not about guessing short-term movement. It is about setting a valuation threshold, being compensated for commitment, and managing capital with discipline. You are either paid to wait or you acquire quality at a discount. That is the framework.